the basics about some of the different loan programs, and we can always get into something deeper and more detailed maybe on another call. But what we wanted to go over today were the basic types of mortgages. So I think I'll start out because I know there's some investor interest here. You essentially have two types of loans, right? You have primary occupancy loans, which means the house that you are going to live in. Then you have non-owner occupied homes, which are basically rental properties, right? And so those two categories of mortgages have a lot to do with what terms are available. So depending on whether you live there or you don't live there, it can change things. When we look at homes that are, or loan programs that are your primary residence, those are typically the loan programs with the most favorable lending terms, lowest down payments, lowest interest rates, easier qualification standards. When we move into the other category where we're looking at purchasing an investment property, then it changes the picture a little bit, and then it requires greater down payment, a little more strict qualifications, and the interest rates are higher. The reason that they're so different is risk. So when analyzing risk, investors and mortgage companies in history will tell us, if you as a consumer get into a difficult financial position, we know that you'll do everything you can to keep a roof over your own head. But if you had multiple properties and you really were in a financial pinch, the properties that you would stop paying on first are the ones you don't live in, naturally, right? Especially if rent wasn't coming in. So, they look at the lending in a risk, from a risk lens. So that's why there's a greater down payment and there's greater requirements on non-owner occupied homes for that reason alone. In case you hit a financial hardship, which home are you going to pay for if you could only pay for one? Your rental property or the one you live in, right? Now, hopefully you have tenants covering the rent and they don't stop paying, then you're fine, right? But they have to look at it in a worst case scenario. So when we look at investment loans require a 25% down payment. And right now, because of COVID, the loan regulations have gotten a little more strict. So it also requires you to have 6 months worth of reserves. And what they mean by that is your total of principal, interest, taxes, and insurance for that home after closing. So after down payment, after closing costs, you still have saved up somewhere in some sort of an account 6 months worth of that housing expense. And so that's the requirement on an investment property. And interest rates fluctuate daily depending on your credit score and the total package and the property type and so forth. But they're anywhere from the high 3s to the high 4% range, kind of depending on the whole combination of those things. So that's essentially it for investment property loans. And investment property loans, it really narrows down the loan options as well. So the loan products that are available for investment properties are conventional loans. The other loan types that we've heard of and we can touch on are only for primary residences. So let's talk about that for a minute. So your primary residence, there's several loan products that are on the market for that. Clearly, there's the conventional loan product. There are VA loans, FHA loans, and USDA loans. So those are basically the main 4 buckets of loan types for your primary residence. And all of those have a low down payment option with them available to them. And not that you have to take it, but they all have an available one. And there's pros and cons to each one. But generally speaking, they will be easier to qualify for. They will allow a little bit lower credit score, clearly lower down payment. For VA and USDA loans, 0 down payment. For FHA loans, it's 3.5 down payment minimum. And for conventional loans for first-time homebuyers is a 3% down payment. So there are some really good loan programs available to get you into a home with low down payment. And those properties, and what most investors do, especially getting started, is they will buy their primary residence and eventually convert that into a rental property. They'll move out of that and move somewhere else and keep that home and make it a rental property. It doesn't mean you have to change the loan. So let's say you bought a house this month and you did a 3% down first-time home buyer conventional loan. And a year from now, you decide to move to another location and buy a new house. Well, you can still leave your original mortgage that you purchased this home with. You can still leave it on there. You don't have to make any changes to it. You probably want to change your insurance because you'll have a renter in there now. But outside of that, you don't need to make any other changes. So you can leave that loan on there indefinitely. And you can keep doing that for each of your subsequent homes. So the next home you can buy with another, low down payment mortgage product. And after you decide to leave that house, convert that into a rental, you can leave that loan on it. So those are essentially the basic nuts and bolts of the mortgage programs available for both investor and primary owned homes. Do you guys have any questions about any of that stuff?
Yeah, Jason. Hi, this is Winston.
Hey, Winston.
Yeah, quick question. You say that, first home and then a year later, move out and go to another home. And then that second home is considered a primary residence, or which one is a primary residence?
The one you're going to live in is the primary residence.
So the one with the tenants became the investment property?
Yes.
Okay. And then some people do the, vacation home. So what is the difference between you go that pattern instead of doing the vacation home for the second one? So what is the difference?
So vacation homes have to look like a vacation home, right? So the down payment requirement for vacation homes is kind of in between rental properties and primary residences. So, a second home isn't going to be a duplex, right? A second home is going to be a vacation home. It's not going to be in the same city where you currently live. So it has to make sense that it's actually a second home, right?
Yes.
So as long as all those factors, and underwriters are very cautious around second homes because they're fearful that people are going to try and take advantage of the system and actually make it a rental property day one instead of truly own it as their vacation property. So it has to be something that, generally speaking, is 60 miles away from where you currently live. There can be exceptions to that. If let's say you live like in my area in San Diego, for example, and you live maybe in a suburb, but you bought a vacation home that's right on the coast. That would make sense, right? Because it's a vacation area. What wouldn't make sense is living in the suburb of San Diego and then buying a home in a suburb of LA and trying to count that as a vacation home, because the suburb of LA really isn't a vacation location. However, let's say you bought a home up at, in the mountains by the lake. That would be a vacation home, right? It makes sense that it's a place where you would vacation. So it has to make sense that way. Typical vacation homes are going to require 20% down payment, so a little less than investment property, and the interest rates are going to be a little better than investment property rates. Usually they're pretty close to what the primary home rates are going to be.
Okay. So like your example, you are in San Diego, and then people want to buy downtown LA as a vacation home. They want to visit it. Why not? They can assume that one is a vacation home, right? Why does it make sense that only to be in the beach or mountain area it should be vacation home? Why is that the assumption?
Well, I'm just using those as examples. So yeah, you could buy, you wanted to buy a condo in a high-rise building in downtown LA, then that would work. That would be fine. It just has to make sense, right? So typically people aren't going to be living in the suburbs of some big city and then buy a vacation home in the suburb of another big city, unless they can demonstrate a real reason for it, right? And, maybe that was the city where they were born and raised, and, the family all lives in that neighborhood and stuff like that. You can make some argument for that you want to go, buy a second or vacation home there. but it just has to make sense. So they're scrutinizing that to make sure not trying to get a lower down payment loan for a rental.
And the bank doesn't care about, they really care about it? Because most of the bank doesn't care. You know, the main purpose is they want to borrow the money, right?
No, the bank cares very much. They're concerned about mortgage fraud.
I see.
Because what happens, so remember, the banks are always looking at worst case scenario. The banks aren't looking at making interest, right? We look at that as consumers because we think, man, if I had a lot of money, I would lend it for and charge people interest, right? And that sounds very profitable. But the banks and the mortgage companies aren't viewing it in that way when they're making a decision on whether or not to lend. They're not looking at it going, hey, this guy wants a $400,000 loan. We could charge him 3.8% interest over 30 years. We're going to make, 300 grand. That's not how they're looking at it. They're looking at it going, okay, we're going to make this $400,000 loan. What happens if he quits making the mortgage payment?
Okay.
What does it look like then? That's what their viewpoint is. What happens when you quit making the mortgage payment? Because then they're going to have to investigate it. Well, did he quit making it, and they investigate it and find out that it was never used as a rental or a vacation home? It was used as a rental, and they do Google searches and they find for rent posts all over the internet for that home. Now they know that it was not purchased for the same intent that it was used for, and that brings on legal liability to you. So they could come after you, and it's jail time. You can go to jail for it.
But this is theory, but in reality, but doesn't care, I don't know if you have any experience by looking at after they borrow the money, they keep on track, your property. It's very rare, right? Because, I never encounter, I'm assuming that, you never encounter those kind of scenarios. They don't have the time to look at, your 2-second house is a renter, or, you still using it as a vacations, or how can they determine? And then do they have a special unit or department or a person who trace all the borrower? What's your advice?
Well, they're not going to be checking on you because there isn't a special unit or anything that keeps following up. But banks do get audited regularly by the federal government, and there's a couple different entities that can do audits on mortgage companies and banks. So it could come up in an audit, right? If they audited a loan that was designated for a second home, the auditors are going to search the internet. And if they find a for rent post, then the lender's in trouble, and so is the person who borrowed the money. Now, I would say probably your smaller banks, like your local banks or credit unions, they probably do check up on it more frequently because they have more to lose, right? If someone commits mortgage fraud on a $400,000 loan at a small bank, that's a really big hit to a small bank versus a Wells Fargo, where they wouldn't notice $400,000 if it hit them in the face, so because they're so big. So they don't have anyone that's out there policing it, no. But you run a very high risk of using it improperly.
Okay, got it. Thank you.
So Jason, I would like to clarify one thing. Just now you mentioned conventional loan is 3% down payment.
Right.
Because I was thinking, I thought conventional loan means you have to pay 20% down payment.
No, so conventional loan doesn't mean that.
Oh, okay.
So where the 20% down payment thing comes from is what's called mortgage insurance. So anytime you borrow money for a real estate and you put less than 20% down payment, the bank is going to make you carry mortgage insurance. So the only exception to this are VA loans and USDA loans. But the mortgage insurance insures the bank in case you default on the loan. And it's because you're higher risk because you put lower down payment. So the bank is making you insure, right? The VA, the reason why rates are so great on VA loans is because the VA guarantees the loan for the service member or the veteran. They guarantee it. So there is a type of insurance that protects the bank, right? So even on a VA loan, if someone were to default, you're not paying for private mortgage insurance, but the VA covers you. So the VA would then step up if you were defaulting and pay 25% of that loan to the bank to keep them whole. So it is a form of mortgage insurance in some fashion, but that's the reason where that 20% threshold comes from. So on the flip side of that, if you did get a conventional loan, and let's say you put 3 or 5 or 10% or even 15% down, right? You still didn't have the 20% and you carry mortgage insurance for a period of time, you can actually get mortgage insurance dropped on a conventional loan. So on a conventional loan, once you get to that 20% equity threshold, you can call the phone number on your mortgage statement and let them know you'd like to remove that mortgage insurance, and they will have an appraiser come to your house. You'll have to pay for the appraiser, but they'll have an appraiser come appraise the home. And if you do in fact have 20% or more equity, then they will stop charging the mortgage insurance. The mortgage insurance that does not go away is on FHA loans. So it used to. The Obama administration changed the rule to try and capture more money for the Federal Housing Authority. So they made the mortgage insurance on FHA loans permanent. So it doesn't matter if you only owed $5 on that house. If you have an FHA loan on it, you're paying mortgage insurance until that loan is paid to zero. So it's permanent on FHA loans. You can refinance out of an FHA loan. You could, a couple years down the road when you had better equity position, you could refinance, put a conventional loan on there and get rid of the FHA loan. And a lot of people do that. But FHA's mortgage insurance is permanent no matter your equity position.
Oh,
So Jason, one quick question on that. So the down payment and the PMI requirement, is it the only relationship, or if you pay like lower down payment, does it matter on your interest rate?
It does. So interest rate is affected by your down payment as well. So especially on conventional. On FHA, it really isn't. So FHA, from an interest rate perspective, operates similarly to VA in the sense that because it's government insured, it's lower risk to the banks because they're getting greater coverage from the government in case of the default than the private mortgage insurance carriers. So they're getting greater coverage, so they keep the rates low. So on FHA, if you had a 3.5% down payment, your interest rate is going to be the same as if you went 10% down payment on an FHA loan. So the rate won't change. On conventional though, 3% versus 10% down payment will change your rate on a conventional loan. And the greater your down payment, the better your interest rate.
Got it. And even if you bind the points, does it matter?
Well, the points help for your rate. They don't affect the loan to value or the equity position. They just affect the interest rate, right? So points is a really good topic. So the way that when we pull interest rates, right, when we have your scenario and we know your property type and your credit score and your down payment amount and all that stuff, and we put it in and pull interest rates, what we see on our side is we see a whole range of interest rates, right? So we'll see the very lowest rate that's available to the highest rate that's available. And in between there, it's 1/8 of a percent all the way. So every 1/8 of a percent, there is either a cost or a credit associated with that rate. So typically when you're calling a mortgage company to ask what their interest rate is for your scenario, most, or at least the way I quote interest rate, is at what we call the par rate. So what I mean by that is, so we have this spread of interest rates, right? Lowest over here, highest down here. Somewhere in the middle-ish is the par rate, meaning that's the interest rate for your scenario with no points and no lender credit, right? Or maybe it may not be exactly zero, but very close to zero on both of those planes. What happens is if you go lower in interest rate, then the points start to accumulate and they're not even. So let's just use an example. Let's say for your scenario today, the par interest rate is 3.5%, no points, no lender credit. And let's say you really, really want 3.25, like that's the rate that you really have your heart set on. Well, we can pay the points to get down to it, but it's not even. So 3.5 below that is 3.375 and then 3.25, right? So it's 1/8 of a percent increments. So at 3.375, let's say, just as an example, let's say the points to get to 3.375 are 0.3. points. So 0.3% of the loan amount. Let's say that's what it costs to go down an eighth. But to go down to 3 1/4, let's say it's 0.7. Let's say it's almost 3/4 of a point. And maybe down to 3.125, it's just a hair more, 0.8. And maybe 3% is a 1.25, right? So they can differ. That point cost for the rate is not even spread all the way down the rate sheet. It can vary. And the lower the interest rate gets, the greater those points get. So I've seen on the, the lowest rate, for example, that I'll see on my rate sheet, sometimes it's 4.5 points for that rate. I don't know anybody that would pay 4.5 points for the lowest rate on the rate sheet, but in theory you could. It wouldn't make mathematical sense, but in theory you could, right? And then going the other way. So choosing a higher interest rate than the par rate, then the lender provides a credit towards your closing costs. And it works in the same fashion. So every 0.8% increment you go higher in rate, then a lender credit begins to appear. And the higher you go in rate to a certain level, the greater the lender credit. So it can be a tool when buying a home and you're either short on money for closing costs, or you just want to keep some money in your pocket. Then you can look at potentially a higher interest rate and have the lender come in and pay some of those costs for you, and keeps your liquidity a little bit higher. And people have a strategy that they'll use around that as well, depending on who you are and what you're doing. But basically interest rates, think of it, remember, like on a playground, like the teeter-totter, right? Sit on one end and the other side goes up, and vice versa, right? So interest rate is kind of the same thing. The lowest interest rate is going to have the highest fees, and the highest interest rate is going to have the highest lender credit. So usually people are somewhere in the middle, close to the middle, where it's not too far out of balance either way. But the nice thing on points, if you do buy points on your primary residence, those you can deduct off your income taxes. So there's on top of having a lower payment and a lower interest rate, there's that additional benefit too.
My question is, Jason, this is Winston. My question is, you say that, these points I can deduct from the tax purpose. But the thing, let's say my mortgage, my house tax is, 10,000, more than 10,000. I say can get a benefit from the points for the tax purpose. Because, Trump, they say that 10,000, right? Because, we already maximize. How can I get a tax benefit by buying the points?
Well, the 10,000 thing that you're referring to, I believe, is property taxes.
Yes.
So this is not taxes. These are loan costs. Is there a limit to it? I couldn't tell you. I'm not a tax professional. So that's a better question for a tax expert. I'm sure there probably is some limit, and I don't know what it is. But the average person is probably not going to spend the type of money in points that would take you to the limit of the tax limit. I would doubt it. I got to imagine it's probably a fairly high number. And it probably has a lot to do with your tax bracket as well, right?
Yes.
So depending on your tax bracket, the points deduction may have a greater or lesser impact depending on where you fall in your tax bracket. So probably the lower your tax bracket, the greater impact it has, and the higher your tax bracket, probably the less impact it has, is my assumption.
Yeah. And then another question is, if you buy the points, you have to stay in this house longer. For example, you buy the points and then you stay for 5 years. That means you are losing. So what's the purpose of buying the points? To lower down the interest rate? What's your calculation?
Well, the longer you stay in the house, the more you win, not the more you lose.
But I'm saying that, if, let's say, you stay for 5 years, you never win, you lose, right? For buying the points.
Well, it depends on the math.
Mm-hmm.
So it depends on how much you spend on the points versus what your savings is by doing that, right? Mm-hmm. Sometimes it doesn't make sense to buy points at all.
Yeah.
And sometimes it makes great sense to buy down maybe a little bit, right? So depending on the day you're looking at rates, maybe getting down 1/4 point in interest rate is a really small cost. Maybe it's like a few $100s. Well, if you plan on staying in the home for 5+ years, that few $100 expense that you incurred for points is really, really profiting you, after 5 years, because you'll definitely make that up. So it just depends on the amount you're spending versus the amount that you're saving compared to that day's par rate. So again, like if par rate was 3.5, but you could jump down to 3.25 for $600, and you're going to keep that loan for 5 to 7 years. That's a total win. You should absolutely do it. And I would recommend that people do that when it's priced like that. But conversely, if 3.5 is our par rate and 3.25 is going to cost you $3,600 to get down to 3.25, probably wouldn't do that. But 3.375 might be something that makes sense. So we might look at that instead.
Oh, okay, got it. Yeah,
Alright.
thank you.
Hey, Jason, could you please touch base on 2 or 3K loan and for the primary residence, and what is it called, home style renovation loan for investment properties?
Yeah. So what Han's referring to are the renovation loan programs.
Yes.
So there's a couple different renovation loan programs out there. There's an FHA version, there's a conventional loan version, and there's a VA loan version. Right now, because of COVID and the social distancing requirements and so forth that are in place right now, all renovation loans are on hold. They're suspended. We can't access them. The only exception that I found to that is the FHA one if the home is vacant. And so the reason why these are suspended is because appraisers right now are mandated not to go inside homes. And it is impossible for the appraiser to do the job that they have to do in a renovation financing without seeing the inside of the home. So the only reason you can do it on vacant, because they can go on the inside of the home and do the inspection, right? You can use these programs though in a refinance or a purchase scenario. I will tell you, in a purchase scenario, it's a slower moving loan than a traditional purchase. So I've had instances where that was a challenge in getting offers accepted coming in with a renovation loan, because depending on the market you're buying in, some markets are hotter than others. And if you're buying in a hot market, a renovation loan may thwart your ability to close on a home or get one accepted into contract. But that being said, the renovation loans take a little bit longer. There's just more people involved. There's more moving parts. There's more steps on a renovation loan than a traditional loan. But generally speaking, the renovation loan will allow you to finance in the renovation costs of that home. And what happens in the process is, once we begin the loan, we'll need the bid from your contractor with everything that's going to be done and the estimated cost. And we add an extra 5% to that cost just for cost overruns as a buffer. And then the appraiser, when they go to the house, they have to have your bid with them. And they do all their measurements and pictures and all that stuff. And then when they create their appraisal, they're using a forecasted value of what the home will be worth once the renovations are complete. So they're not giving you a today's value. They're giving you the future value of the home once it's completed. And they need that repair estimate to do that. And so that's how the appraisals are done. And then as the loan goes, the builder has to be vetted out, has to be licensed, insured, bonded, all that stuff, so that, the bank is secure in giving them money to work on your house, right? And once the loan is closed, so if you're in a purchase, once the loan is closed, or even a refinance, when it's closed and they fund the loan, the dollar amount for the renovations is put into a side account, which is a construction control account. And so there's usually a disbursement schedule put in place for the contractor. So usually they'll get, 25 to 30% of the money right away, the contractor will, to begin all the construction. And they'll have some benchmarks in there where the builder has to get to, and then money stops. It's got to be inspected to make sure he's done what he's supposed to have done so far. Then the next chunk of money comes, and he works on the next section of work. Then it gets reviewed. Then the next section comes, depending on how grand renovations are, there could be some different stops along the way, but that's how it works generally speaking. So you can do it for a primary residence using an FHA loan. The 203K is what it's called in the FHA version. So the loan itself functions in the same manner. You still need 3.5% down payment on the purchase price, and you can finance in renovations. There's two different types of FHA 203K loans. One of them is a little more limited in scope than the other, but they're both good. Just depends. And the only difference to you really is the total dollar amount. So one of them is $35,000 and under. The other one lets you go over $35,000. And there's just some internal differences on how the transaction is processed for the lender. Conventional loans, the conventional renovation loans have the most flexibility, meaning you can do the most type of renovation with those, right? You can repair a pool, you can move walls, you can add walls, you can do engineering, structural things. It's the most loose, but you have more down payment on a conventional loan than you do some of the others. So that's kind of the give and take on those. And then the VA renovation loan is a little more restrictive on what you can do because they don't want you doing major structural changes or adding bedrooms or things of that nature. Renovating the house is fine, but they don't want you making major structural changes to the home, unless there's an issue that needs to be repaired. But they don't want you, removing the wall so you can have that open floor plan. Like the VA renovation loan isn't a good product for that, but FHA and conventional could be. And the nice thing about the FHA and the conventional ones is you can add on bedrooms. So it's actually a really neat product for the scenario where, maybe you buy a 2-bedroom, 1-bath home, or a 3-bedroom, 1-bath home, and a 3-bedroom, 2-bath would really help value and resale and all that stuff. So you could, in that instance, add that second bathroom on, make it a 3-bedroom, 2-bath in that instance. Or, some homes don't have like a true master bedroom. You make it a true master bedroom or whatever. I mean, there's tons of options, but you can add on square footage to the homes and things of that nature with the renovation product, which are really cool. There are some construction loan products. Those are all suspended as well as a result of the COVID thing. But when they come back, the construction loan products are pretty cool too. There's a VA version and there's a conventional version. Essentially, you could buy a piece of land and custom build a home. Or you could buy an existing home and demolish it and rebuild, either using the same foundation or modifying the foundation, but you could buy an existing home and tear it down and build something new. So the construction loans function in a similar manner to how I explained how the renovation loan does with the construction control account and stuff like that. I'll tell you the interest rates on these things are usually 1 point to 1.5 points higher than just the plain regular mortgage without the renovation or the construction piece to it. So they're a higher cost for the loan. And there's some more expenses in there. So I would say that they're, especially on the construction side, is not a good product for a first-time home buyer. Unless you've got a big bank account, because you're just going to have expenses that come up that surprise you, because there's so many parties involved in building a home, from engineers to the county to the city, coastal commissions, all surveyors. There's just so many different people involved on top of the builder that in a construction situation, a lot of them are going to require some pretty hefty down payment, like retainers to retain their services, like your engineer or your architect, right? Not all of them are going to allow you to pay them at the close of the loan. A lot of them are going to want to be paid up front, or at least partially paid up front. So it's not a good product for someone with no cash and trying to buy their first house. Construction loans are just more cash intensive. But the renovation loan program you could do on your first home. You just need your money for down payment and closing costs, and you can make that work.
So Jason, so that renovation loan program 203K, or for the investment properties. So how they work is it's just one loan, right? Purchase price and rehab cost, they combine together in one loan.
Correct.
Okay. Yeah.
Correct. Yeah. So when you close on the loan, let's say you bought a house for $300,000 and your renovation costs were $30,000. So your new loan is going to be $330,000.
Okay. So the down payment, let's say if I pay 3%,
Minus down payment. Yeah.
so it's a 3% or 330,000.
Right.
Okay. Yeah. I just want to clarify because one of my renter, I use the home style renovation loan. Yeah. So that's what they did. Purchase price and yes, and the renovation cost, they combine together. And then yes, it's a long process. The appraiser has to come out and they have to do the like by phase. Okay, phase 1, then they disperse the fund
Right.
to the contractor, and yeah, contractor has to be licensed contractor and stuff like that. Yes.
Exactly. Yeah. So there's different phases, and it does take longer, but it's a really cool program. I've helped a couple. I haven't done a lot of them. I've done a few. And I've had some that went pretty good. We got them done in 30 days, and some took longer. And sometimes, it's not taking longer from the lender perspective. But one thing that people, I think, forget when they start in on these loan types is that contractors are not good paperwork people. Contractors are really good at building stuff with their hands, but they're usually really terrible at paperwork. So a lot of times where we get slowed down in the process is obtaining the paperwork from the builder that we need, because we need licenses and application forms and stuff filled out by them and everything else.
Yes.
And that's not the normal part of their business day for a builder, right? They do little bits of paperwork, but not lots of paperwork like we need on the loan. So bear that in mind. I had one where it was a purchase and they contracted a builder to do the renovations, and they had the bids and everything. But when they went into escrow and they finally found a house, the builder was on a 2-week vacation out of the country.
Oh.
And they had a 30-day escrow. So then they had to scramble and find a new builder that would build it for the same cost and could go right away with the paperwork. And that guy, because he took vacation when he took it, lost out on the job. But we couldn't wait 2 weeks to start the loan because we only had 4 weeks to do the whole thing to begin with. So, sometimes the builder, that's the other moving piece, and the builder can have a big impact on whether or not we're successful at the timeline.
Okay. Jason, one more question from me, which is do you know any, is there any like gauge or any estimated amount for the PMI?
Yeah, so it depends. Well, if it's FHA, it's 0.8% of the loan amount divided by 12. That's the FHA one. And FHA also has an upfront mortgage insurance premium that's tacked onto the loan of 1.75%. So mortgage insurance on an FHA loan, you get hit twice. On conventional loans, it varies based on your credit score and your down payment. So depending on credit score and how much down you're putting, the mortgage insurance rate can vary. So, sometimes I've had people where they just didn't have quite 20%. They had like 16%, they were close, so they just didn't have it all. And the mortgage insurance was really small. It was a small dollar amount, so it was very tolerable. And I've had other people where, credit score wasn't that great and they didn't have a lot of down payment, and that mortgage insurance premium was high, a couple $100 a month. And so it just takes all that stuff into account.
I see. Okay.
So Jason, according to your explanation, my understanding, if you had a good credit score and if you had a down payment, you should go to the conventional loan instead of FHA. Are you saying like this?
Yes. Yeah. So they're great programs for the right scenario. But yeah, if you have down payment and good credit scores, then you're going to be wiser to go with a conventional loan. The cost of the loan is lower, even though the rates are different, right? So your interest rate on an FHA loan is always going to beat a conventional loan. But the carrying cost, because of the mortgage insurance, the upfront and the monthly with FHA, is always going to beat the conventional. So if you can qualify to go conventional, even though rate isn't going to be as attractive, the conventional loan is a smarter financial choice. But FHA does have its place. One of the neat perks about FHA and why people will use it sometimes that have great scores and have some money for down payment. One of the reasons they'll use it is because it can go a little higher on debt to income ratio. So I've seen people where now they've got a couple rental properties, but they're writing off as much of it as they can on their taxes. So they're not showing much, if any, income from those, hopefully enough to just offset the payment. But now they're trying to buy house number 3 and their debt ratios are high, and maybe they're not a veteran either, right? So FHA loan in those instances may be the only option because their debt ratios are higher, right? So sometimes it's the right tool for the right situation.
Got you. And then you are discussing about the construction area. And then I encounter in a hot market, and then developer want to sell pre-construction sales. So if if I'm interested for the pre-construction sales, how the bank will be working? Because that pre-construction, construction not completed yet. So how bank will be involved those kind of situation, and then why developer can sell pre-construction sales with a different price?
So you're talking about if you went to like a new home development?
Yes, like a condo, big condominium, and then they're still doing a construction.
Yes. So the loan that you get, if you're a buyer of one of those homes, the loan that you're going to get is just a standard loan. So your loan isn't a construction loan. The builder got construction financing to build the entire development. So their money and their loan is being used to build your home. You're just getting a loan for the end price, and that pays back the money that they incurred to build it plus their profit.
But the thing, they're still constructing the building, and then they don't have their CO, and then the bank cannot do the closing. So how we borrow the money from the bank,
So, the bank can't fund until the certificate of occupancy is ready. So, you got to wait till construction is done. My home was new construction. So, we couldn't close on the loan until certificate of occupancy was available. I just did one for a client here in San Diego, and we just closed on it. Same thing. And we were waiting. That certificate of occupancy delayed us a week. We just had to wait. There's nothing we could do. They can't give the final approval on a loan without that certificate of occupancy. So that has to happen in order to close.
So it is safe to buy the pre-construction sales as a buyer, or is very high risk because you don't know that the construction will be finished, or is there any any citations or anything happen, and then there's a pre-construction sale price.
Well, the pre-construction sale price is great to jump in on because your mortgage. So let's say right now you jump in on pre-construction price, and all they've done is grade the dirt. They haven't built anything yet. So you put a deposit down. Oftentimes they're going to ask for like 10 or 15 grand for a deposit, right? And that reserves your place. And then you get pre-approved for your mortgage. The mortgage company isn't going to start working on your loan until you're 60 or 90 days away from your certificate of occupancy. So they're not going to do anything on your mortgage. They'll pre-approve you. So they'll check your credit. They'll look at all your documents and everything else, but you might be a year away from construction being completed. And that lender is not going to even start doing any work, like real work on your loan, till you're about 60 to 90 days away from actually occupying the house or being able to close on it from completion. So, there's no risk to you except for your deposit. So, you put deposit on this pre-construction sale, and the contractor goes bankrupt before they build it. Well, then, that was the risk, was that 10 grand or whatever. But you don't have, this big, $400,000 loan that you have to pay back either, because the loan hasn't been done, and it won't be done until the house is complete. So you won't have a mortgage obligation whatsoever until that house is complete and you've closed escrow on it.
But the risk for losing that deposit is possible, right?
Yeah, it's possible, but you got to do your homework on the builder and stuff and get an idea of whether or not the risk is worth it. There's such high demand for housing in this country and such a low amount of inventory that I would imagine that most builders are going to be fine and able to deliver the product. But you want to do your homework. You know, I mean, is it a brand new builder and this is the first development they've ever built? Then yeah, maybe there's more risk. Is it a local builder that's done 200 developments? Okay, then you're probably fine. Is it a big national builder like Lennar Homes? You're totally fine. They're not going anywhere, right?
Yes.
So, I mean, you just have to do your homework. If it's, you know, if it's the father and son construction firm down the street and they're building 3 houses in one plot of land, a little higher risk.
But the thing is, you know, in like this kind of pandemic, yes, they are not bankrupt, but you lose. I mean, let's say I lost my job because of pandemic, and then a year later they finish. Yeah, everything they finish, and then they ask me to close. But I don't have a job. Bank doesn't want to borrow the money, so my deposit will be gone, right? Those kind of risks, you know.
It could be, depending on the terms of your contract. It could be gone. Yeah. And it depends on what phase you're in too. So like I remember when I bought our house, the builder had different phases where we had to have money for certain aspects, right? You had the deposit initially, and then there were different kind of benchmarks along the way. There was an additional deposit that was due after a certain point in construction, and then that at that point they had to like really begin the loan and verify employment and all that stuff before we started choosing our options for the home. You know, the countertops and those and the paint colors and those kinds of things. Before we selected that stuff, they had to make sure that we were still solid buyers. So then they revisited our pre-approval, make sure we're still employed, all that stuff, and then we had to pay a portion of all those upgrades out of pocket. They didn't just throw them on there for us. So, you know, they're going to make sure that they're not going to build a home for someone that can't close on it. You know, I mean, of course, anything could happen. You could lose your job the day before closing. That could happen, right?
Yeah.
In that instance, depending on who the builder is, they may keep your deposit. Now, some of them may refund it to you, but it depends, right? I know, like with our home, we made a lot of choices and a lot of kind of custom things to it. So for the builder, they were more nervous about us as buyers because if we fell out for whatever reason, they had a home that was very specific to us that may not be as appealing to another buyer. And so the risk is higher to the builder. Now, will they be able to sell it and get the money they need to clear the capital that they need to clear with a different buyer other than us? You know, maybe not every buyer likes the things we chose. So there's a risk to the builder also that they're worried about as well. So that's why, you know, they have some of these checks and balances along the way.
Okay, thank you, Jason.
Yeah.
Okay, thank you, Jason. So now the time is running out. So if you have any more questions, we have a few minutes left before Jason call for the day.
Yeah, I want to give a chance to other people. If nobody has a question, I want to know the opinion between 15 years and 30 years, like you recommend for first-time home buyers?
First-time home buyers, I don't recommend 15-year loans unless they have a high level of income, because you're taking that mortgage repayment period and you're chopping it in half on a 15-year. So the payment goes up quite substantially. Most first-time home buyers can't qualify for a home at all on a 15-year loan because the payment's too high. So a 30-year loan is where they'll be able to qualify. Now, from a financial standpoint, a 15-year mortgage is an extremely smart financial move. And it's much smarter than a 30-year mortgage. But the payment is higher because you went from an amortized loan spread over 360 payments on a 30-year to an amortized loan spread over 180 payments. So the interest saved is tremendous amount of interest if you're going to keep that home and pay it off in 15 years. It's huge. But not everyone can qualify with or stomach that larger payment. Interest rates typically for 15-year mortgages are lower than 30-year fixed mortgages. So there's a slight benefit there, but they're not low enough. There's not enough of a spread between 30 years and 15 years where the payment difference is small. The payment difference is still pretty big.
Okay.
But yeah, super smart. And you can do other shorter terms. You can do 25-year loans, you can do 20-year loans, and you can do 10-year loans.
Can you take like 30 years loan and like pay extra to the principal and like make it 15 at the end?
Yes. Absolutely. Absolutely. They say if you make a mortgage payment, and one extra mortgage payment a year, you'll pay your loan off 8 years sooner.
Wow.
Just one extra payment. So, for a lot of people, that's like their tax refund at the end of the year. Just apply that towards your mortgage. Or depending on the amount of your mortgage, it might be an extra $100 a month, or $200 a month. And then some of the lenders will offer you the ability to switch to biweekly payments. So every 2 weeks, half of your payment is due. And if you elect to do that, there's 26 pay periods or in a year. So you end up making that one extra monthly payment every year. So biweekly is another good way to do it.
Thank you.
Yeah. Good question. Anybody else?
Yes,
Any more questions?
Jason, this is Zoe. We talked about a couple weeks ago. Anyway, thanks for coming. And my question is, did you not mention that the interest rates are tax deductible at the end of each year?
Your interest paid, your mortgage interest paid is deductible. Yes.
Okay.
Yeah.
Just wanted to clarify that. Thank you.
Yeah. And if you have rental properties, so here's another one so if you have rental properties, of course, one of the objectives is to write off as much income as you can on your taxes, so you have less tax burden, right? Less taxes to pay. That's the goal. But there's certain categories when you have rental properties where you can have your write-offs, but where we, as the mortgage person, can add that money back in for income calculations to help you with debt ratios down the road. So there's a little bit of a strategy there, and I work with a lot of people's accountants when it comes close to tax time before they file, and the accountant and I will go back and forth working on this section of their tax returns together to help them for their next home purchase that they plan to do maybe later that year, to get their debt ratios as low as possible without incurring a big tax bill either, to try and find that fine balance. So depreciation is the biggest category. So depreciation, I can add that back in. So you can write it off, but I can add it back in for income. Mortgage interest, property taxes, and if you had a mileage expense for your car, a small portion of that we can add back in. Anything else you write off, like you had to make repairs or something like that, or marketing expenses to rent it, none of that I can add back in. So insurance, that's the other one I can add back in is insurance. So I've seen some people make the mistake of forgetting to put in what they paid for taxes or what they paid for insurance. And that's too bad, because then when I go to work on their loan, there's, some added income I could have thrown in there, but they didn't deduct it at all. So they didn't get the tax benefit, number one. And number two, I don't have it as income to re-add back in. So when you start doing that, it's important to, maybe talk with a loan officer and your tax guy when you're preparing, before you prepare your taxes for the tax year, if you plan to buy more property, because we always do a 2-year look back on taxes. So you want to, make that fine balance of pay as little taxes as you can, but not so little that it hurts you for qualifying for another house down the road.
Let's say, you and your wife, and then you buy the home as a first-time home buyer. Is your wife can buy her name with the first-time home buyer, or how it works? Husband and wife.
It depends. Depends on the state that you live in, and it depends on how you hold title.
I see. Because I live in New York, so let's say you buy as a your with only your name as a first home. Is your wife eligible to buy the first home only her name, or?
Well, they're gonna have to be able to prove that they didn't have a primary residence for the last 7 years. So it can get a little tricky to do that. And you're only talking about down payment difference of about 2%. So you're not talking tremendous dollars between first-time home buyer and not first-time home buyer. So it depends. New York's not a community property state. So if you bought a house and your wife is not on the loan and she's also not on the deed to the house, then we might be able to make it work. It's going to be underwriter discretion.
Okay.
But if you needed her income to qualify on the home that you bought in your name, then she's on the loan, so it's not going to work, or vice versa.
Yeah, that one I understand. But in individual, you have your income, your wife has your income, her income. So I'm like we can be at as an individual, even though we married.
Yeah. I mean, your wife couldn't be on the deed to the house or have any ownership, and you couldn't do it in a community property state. There's 9 community property states in the country. So like in California, for example, you couldn't do that.
Okay, gotcha.
Hi, Jason. Can you please let other people know what are the states that your company is landing right now? Because I know that you don't land on New York, and I don't really I can't remember majority of the states, because some
Yeah.
California, Maryland, and New York. So
Let's see here. I'll tell you. So we just added a couple states. We're always adding states. I mean, our goal is to be lending nationwide. The licensing just takes some time in each state. We do not plan to be in New York ever. The reason is New York is very expensive, both to do a mortgage as a consumer, and also incredibly expensive to be a mortgage company in that state. So currently where we're doing loans are Washington, Oregon, California, Arizona, Idaho, Montana, Colorado, Kansas, Texas, Wisconsin, Pennsylvania, Maryland, Virginia, North Carolina, South Carolina, Georgia, Alabama, Tennessee, and Florida, and Hawaii. The ones that are coming online soon, I can tell you, Nevada is probably going to be online next week. Alaska is in the works. We're working on Alaska. I think Illinois is in the works right now. And I think Mississippi is also being worked on right now. And of course, the goal is to get all of them, except for New York. Some just take a while. Like our North Carolina license took us about 7 months. Our Nevada license we've been working on for 8 months now. So some of them take a super long time. Our Idaho license only took a week. So, some states are very different in just the bureaucracy in their different departments. But yeah, we're working on adding the rest of them in time. I think this year we'll probably end up with another 6 or 8 between now and the end of the year. I know Alaska is probably going to come online pretty quick. That state's been fairly easy to work with.
Thank you. And then Jason, is how people can contact you, like your email address or your contact?
So my email address is jwood@valoanguy.us. So not .com, but .us. And of course, I market and brand myself as a VA loan person or specialist, but I do all mortgage types. That just, in the area where I live in San Diego, it's a heavy military concentration, and the networks and stuff I'm connected in are all very military related. So that's my marketing and my branding as the VA loan guy, but we can do all different loan types at our company. So we can do bridge loans and portfolio loans and apartment loans, all that stuff.
Yes.
Thank you. Thank you, Jason. And I got one question from one of the participants. Would you like to take the question?
Oh, the one in the chat here?
Yes.
Yeah. So the question is, I write off a lot of my expenses and pay as little tax as possible because he's self-employed. And now his income to debt ratio is not good. Do I have to wait another year again? I have really good credit. And then he asks, I'm not a military person. Can I still apply for a VA loan? So the answer to that is no. You have to have served in the military to have that benefit for the VA loan. So no military service, no access to that. Unless you marry somebody who was or is in the military, then you do. But your self-employed taxes come into play, whether you're a VA loan or a conventional loan or an FHA loan, doesn't matter. So when you're self-employed, it's a catch-22, right? You want to write off as much as possible so your taxes are low, but when you go to qualify for a mortgage, that hurts you. So as I was mentioning on the investment property tax deductions, there's some pieces of income that, or some deductions that you write off that we can add back in for income. So depending on how you file your taxes, right, as a sole proprietor or as an LLC, an S Corp, a C Corp, that can vary what items we're allowed to add back in for income. But to answer your question in a more general standpoint, we take a 2-year average on your taxes. So we're going to average income for the last 2 years if you're self-employed. So if you're having a great year in 2020 and you wrote off everything in 2019 and showed no income, then, and let's say 2020, you take 0 tax deductions. So you pay all the taxes you have to pay. We're going to average the two income. So if you had 0 in 2019 and you had 100 grand in 2020, your average annual income is going to be 50 grand because we average the two. Now, if 2019 was a loss, let's say you reported a loss of 20,000 and you report 100 grand of income in 2020, well, now you're at an annual average of 40 grand a year because we have to average the last 2 years. So to get yourself in a position where you'll have more income, then you want to make sure that your tax deductions are as little as possible. I'll tell you guys, depreciation is the biggest and best category. So if you own a business that has equipment, computers, tractors, whatever, vehicles, you can depreciate those in larger chunks to help your tax burden. And that is a big category that I can add back in for income. Another one, do you have a rehabber loan for investment properties? I'm in Virginia. When COVID is over, yes, unless the home is vacant. So if the home is vacant, we can do a rehab loan. But it's got to be vacant because of the COVID and the appraisers being able to inspect.
All right. So any last question?
Yeah, sure. Okay. Yeah, go ahead. Yeah, sorry.
Hi, Jason. I have a question. Just now you are saying that because of the COVID, the property is supposed to be vacant, right? And how many percentage do you loan for the purchasing price?
Well, it depends. It depends on, is the home your primary residence? Is it an investment property?
Investment properties.
Okay, so we'll lend 75% of the purchase price.
Okay. So how about the interest rate?
Depends on your credit and stuff. Interest rates are anywhere from the mid 3s up to 5%. It just depends.
Okay, 3 to 5%. So like if I have an investor, so like me and my investor have to submit the loan together, right?
Yeah, if you're both going to own it together and both be on the mortgage, yes.
So how long it can take?
To what? To get the loan or get you?
Yeah, loan, yes. Mm-hmm.
Well, the pre-approval, once I have all your paperwork and the application, takes us about 2 days, maybe 3 if we're busy.
Okay.
Pre-approved. And then the mortgage itself is taking about 30 days. Like once you're in contract to buy the house, it's about a 30-day process.
Okay. Got you. Thank you so much.
My pleasure. Yeah. Anybody else?
Okay.
Well, thanks everyone. I put in the
Yes.
chat my email address and my website. So if you didn't write it down or I went too fast, you can just copy and paste it and save it there. But I'm happy to talk to you individually if you have more questions on my website, or hit me with an email, and happy to talk to you. But you can schedule an appointment on my website or give me a call, email, whatever. I'm pretty easy to get a hold of.
Yes, and
Yeah, definitely. I will contact you, and I added to you on your Facebook, and I try to get your email address and phone number. So we are looking for the investment property. So I will discuss with you and then reschedule with you. Thank you for your information, though.
My pleasure. Yeah, it's great talking to you guys. I'll put
Appreciate
my
it.
Yeah, Jason, quick
cell phone.
question. Yeah, let's say, you know, if I go through with you and if I go to the bank by myself, what's the difference? Your service and then, you know, you guys borrowing the money, but, you know, what's the advantage of going to your channel and then going to the, you know, Wells Fargo by myself? What's what advantage?
A couple of things. And I actually worked for Wells Fargo in the mortgage division, so I have some good insight as to how it is on the bank side. But the number one thing you're going to experience going through a company like mine versus a bank is the service level and the speed. So the big banks, I don't care which one it is, a big bank or a credit union is going to be extremely slow to close your deal. And the issue that provides for you is getting offers accepted. So most real estate agents realize that big banks are slow and difficult to work with. So if you make an offer on a home and maybe two other people make an offer on that same home and your pre-approval letter is from Wells Fargo and the other two people have pre-approval letters from companies like mine, and let's say you're all offering the same price and the same terms, you will lose every time because of who your lender is. The realtors absolutely scrutinize on that because the realtors are concerned with getting their commission check at the end. So whatever is the path of least resistance for them when you make an offer, as long as it helps their client, right? As long as it works for their client too, that's the path that they're going to pursue. So they know with a big bank, it's going to be slow. There's going to be zero communication. So no one's going to be able to get an update during the process. Usually they forget to do things like order the appraisal, which really delays things. And you have usually your contract timelines around that. And the process is usually laden with overlays. So what I mean by that is usually the big banks are more conservative in their lending guidelines. So let's say you're doing a conventional loan. Well, conventional loans are securitized by Fannie Mae and Freddie Mac, and they have guidelines for what they will accept. Well, if you're doing a conventional loan through Wells Fargo, for example, they too are securitizing that loan with Fannie Mae or Freddie Mac. So me and Wells Fargo, we're securitizing it through the same place.
Yes.
The difference is Wells Fargo is run by shareholders who are very conservative. So you have Fannie Mae's guidelines, and then you have Wells Fargo's guidelines stacked on top of that. So they're going, hey, we know Fannie Mae says this, but we want you to be better. So we want higher credit scores. We want more money in the bank. We want lower debt to income ratios, so on and so forth. So it's called an overlay. So they take the Fannie Mae guidelines and they overlay their own on top of it. And so qualifications can be stricter.
All right, but in terms of the timeline, still we are in a mortgage period, and then the seller cannot cancel because of the because Wells Fargo is delay, and then your service faster. They cannot make a judgment, as long as we are in a period, and then nobody can cancel the contract, right?
No, that's incorrect.
Oh, okay.
Most contracts have contingencies built in there for the lender. So the lender has to perform by certain dates within the contract. And not every state does, but I can tell you, like in California, for example, usually the lender has to have the loan approved in 17 days.
I see.
And if the loan isn't approved, you have to sign off as the buyer on that contingency. So meaning you are blaming the lender for a reason to get out of the contract as the buyer. Now the seller, if you don't meet the deadlines, the seller can send you what's called a notice to perform, which gives you 3 days to hit the target. And if you don't, let's say it's loan approval, and you can't hit it within that 3 days, the seller has every right to cancel the contract on you and keep your deposit, your earnest money deposit.
Okay.
And if you don't close by the closing date, they can do the same thing. So if your closing date is Monday, June 15th, and you don't close because your lender missed the date, the seller can cancel on you and keep your deposit. You don't have a house. They put the house back on the market and they keep your money. Absolutely can happen. It has happened to people. It's not super likely to happen, but if you're looking to buy in an area that is competitive and moves quickly, and I'll tell you, like, for example, Southern California purchase escrows are fast. They're 30 days or less. And in my area, if you come up with a big bank to purchase, you're just not going to get your offer accepted. They're just not even going to talk to you. It doesn't matter how, even if you're going to pay over asking price, they don't want to deal with you unless you're the only offer on that house. But if there's more than one offer, you're losing, because they know the big banks can't keep up on the speed and they can't deliver it, and it's going to be a headache, and people don't like headaches. So where the big banks are advantageous is when you get into the really big loans. So let's say you want to buy a house that's 1.7 million and you need to finance 1.2 million. Okay, now your Wells Fargos, your Chases, your B of A's, those types of players are going to come in to be advantageous for you, as long as you move all your investment accounts and all your bank accounts to their bank. Now, those banks will give you incredible interest rates on these big jumbo loans. Their service still is slow, but typically in that really big jumbo space, the speed part of it is not as big of a deal as it is on more your entry level and mid-level homes. So speed is not quite as critical. But the reason they do that is because the bank doesn't care about the mortgage. They care about the banking relationship. They want your investment accounts. They want your checking accounts. They want your savings accounts, your CDs. They want your business. And so if they have to make no money on a mortgage or very little money on a mortgage, they'll do it to get the rest of your assets, right? You got $3 million in assets. They want that on their books. And they'll give you $1 million loan at 3%. They don't care, because to them, the loan is a loss leader. We got $3 million in the bank. We're cool. We're happy. And that's how they look at it in that aspect. So if you're looking in the big dollar amounts, then that's where the advantage is.
Okay, thank you.
For the banks.
Yeah.
Thank you, Jason. Thank you for your time. And so, yeah, if you have any questions, you can ask him, or you can schedule more time with him to get your loan pre-approval. So, all right. So that's
Thanks,
it.
everybody. Great to meet you. Talk to you soon.
Bye-bye.
Thank
Bye.
you.